Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd. There is a link in the description below where you can get your tickets. And today's guest is an analyst and editor at Exploration Insights with a wealth of experience in the mining industry. It's Joe Mazumdar. Welcome to the show.
Great. Thank you for having me.
Great. Thank you for being here. I wanted to get started with a recent presentation you made at the mining investment event in Quebec, where you warned about a blind rush towards carbon neutrality by 2030. And you stated, rushing the transition without thorough planning can lead to suboptimal outcomes. So talk to us about what you're seeing in regards to the energy transition that has you concerned and maybe thinking that it's being rushed.
So if we go a bit of the background, we're dealing with these things called critical minerals, which are basically key to the idea of carbon neutral technologies, whether it's electric vehicles, solar, wind power, what have you, but more electrification of the economy and less carbon footprint. What I see is that, we're basically dealing with not only critical minerals, but they become strategic because of this path to basically isolate China. And now we have that exacerbated by the Russian invasion of Ukraine. And so we're dealing with the supply and also the demand. And so what I see, one is a lack of a consolidated strategy by the ex-China, Russia countries and regions. Some people have 22 critical minerals, other people have 50. Some people include important minerals like copper and uranium, other people don't. So that sort of tells me that everyone's moving off on their own direction and not considering maybe a regional perspective more fulsome. That's one. The other one would be technology. On the supply and the demand side, it's not constant. So what are we actually calling critical if the technology actually, takes us out of that mineral? Let's say what we've seen with cobalt, because of the security risks with cobalt in the DRC, they've been slowly making batteries that use less and less cobalt. Potentially, an issue with graphite. If China starts making more synthetic graphite, does that cut that out as something that will be supplied by mines? And then also the technology around the supply. So lithium is something that's needed in a lot of batteries, but it's not rare. It's in a lot of places, and so if there's more technologies that can extract it cheaper and impact the supply, that could be something that's important. The other problem is development timelines are long, as we know, 15 to 20 years for some commodities. And now we see, issues with permitting in some places, social license to operate in others. Infrastructure. So if Canada comes to the forefront for critical minerals, we got the endowment. The problem is that we don't have the infrastructure in place. So even if we have a permitted asset, can we actually get this mineral to market? And then the other problem is that, as we drop the grade in some of these deposits, as grades do decline, and they have been declining, the problem is that means more tons have to be mined, and that means a bigger carbon footprint from the potential mine. And so you get into this sort of vicious cycle about, carbon footprint versus, producing the mineral that reduces the carbon footprint. Another risk. And then, lastly, and probably not lastly, I've tried to cover as much as I could, but processing capacity. So as we know, most mines don't produce a final product. We produce an intermediate product. But to get that product that's used in these carbon neutral technologies, we're going to have to process them. Over the last 20 years plus, China has been building up that processing capacity. And now the West has basically have to replicate that. And can they do it in a shorter time frame? That's probably my worries.
Well, I definitely want to dive into some of the metals you mentioned there a little bit later. But first, I have to get your opinion on the BRICS currency because this has been a big headline recently. Many people speculating how much of an impact it could actually have. Do you think talk of a gold-backed BRICS currency is something people should actually be paying attention to? Do you think it could have an impact on the gold space? And do you think it could actually ever be a real threat to the US dollar as a reserve currency?
Okay, so if we do the background, the BRICS were formed in about 2009. It's Brazil, it's Russia, it's India, and it's China, and it's South Africa. And so they've cleverly put up this new currency, potentially called the 5R, or the reporters have, because it's the Real, Ruble, Rupee, Renminbi, and the Rand. Uh, the thing is that the whole idea with the BRICS was increase the global clout of these emerging markets, and then generate a foil to the US dollar and global institutions that are powered by the West, like the World Bank and the IMF. And they've generated a new bank in the interim called the New Development Bank. Okay, so if we look at the US, which is about 40 to 45% of global transaction according to SWIFT is under the US dollar, and about 50 to 60% of reserves, global reserves, are held in US dollars. So that's basically what's backing the US dollars. That's the hegemony that they want to basically try to break. But if we look at the BRICS, consolidate their reserves, they hold about 4.5 trillion, 70% of that is China. The US holds about 0.7 trillion. The difference is that the US backs its reserves 65 to 70% with gold, and that's never changed. Whereas the BRICS consolidated have only 6% backed by gold. And so the opportunity, as people see it, is that, hey, they have to increase the amount backed by gold, and that should be really good for gold. And we've seen that a bit with central banks basically driving gold demand as ETF demand has been very low, and we've seen mostly withdrawals. And the only thing really supporting gold, even though we've had interest rate hikes, gold is still up year to date about 7%, which is very good. Even though the US dollar is down 3 to 4%, gold's still outperforming that by more than it should, I guess. So what I see as problematic is that even the new development bank that was formed by these countries and are looking for more players to come in, most of these economies that they're going to add will be smaller. I mean, the one that's making the biggest impact is China. The other ones, are fractional, but they want to increase membership and they want to lend to their members. So they're building up their asset base. But basically what they're trying to do is when they lend to their members or do increased trade among their membership, they want to use domestic currency and not the US dollar. So that would impact, some of, the conversion to the US dollar. But right now, their CFO is still stating that, their anchor currency is still the US dollar. So they haven't gone off of what's controlling their balance sheet is still the US dollar. So that might change in the future. But the problem is, I think in the end, what's driving the global economy is still the US consumer, and everybody still wants exposure to that. And that's still going to be run by the US dollar. And so until China and some of these other countries can increase their domestic consumption, I think we're still going to be run a lot by the US dollar.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
That makes a lot of sense. And the launch of a BRICS currency might not have much of an immediate impact, but perhaps something to watch as the years unfold, something that could develop.
Yeah, even if we change, a 5 to 6% backing by gold to 10%, that still would have a big impact on the gold market.
Yeah, absolutely. I want to touch on the junior mining sector right now. I'm seeing a lot of negative sentiment on social media, in the YouTube comments, a lot of people throwing in the towel, a lot of people's portfolios deeply in the red. Now, I think a lot of those people who are posting these things have probably allocated a bit too much of their portfolio into such a speculative space. But what are you seeing there? Because you have a ton of experience analyzing the industry. How do you see it positioned at the moment? Is now a time that could be presenting a buying opportunity, or do you think it's best to be sitting on the sidelines and wait to see how things play out?
So in terms of background, in terms of, negative sentiment, if we look at the TSX Venture, I mean, new issues and IPOs, which we actually want less companies, not more companies on the venture. That, it's down 60% in terms of new issuers and IPOs. But the money, this is what drew my attention, was the amount of money raised by IPOs up to May year to date on the TSX Venture is down 90%. So they've raised less than $8 million IPOs up to May in 2023. And that's down 90% versus the same period in 2022. So that's $8 million versus $116 million. And total money raised, whether it's IPOs, secondary financings, what have you, is down 35%. So that's a proxy for your, idea that sentiment is negative. It definitely is negative, and that's, reflected in the numbers. But I would say, like, if you look at it, especially from a precious metal sort of sentiment, because as we went through, the precious metal sentiment is negative, and that's what drives a lot of people's investments in the junior sector now. But I would say some of that is transferring to this critical mineral sector as well, especially lithium. But I would say focus on alpha right now and not so much beta, because beta requires a movement in the entire sector and a drive in sentiment. So if we're looking for alpha, then you can be a near-term buyer. You could look, you're a stock picker, you're looking at quality management, you're looking at asset, jurisdiction, news flow, and access to capital. Very important when the sentiment isn't there, that these people can raise money if they find the right project or they drill the right hole and suddenly they need more money. Their share structure is not going to collapse. So that's very important if you're going to do the alpha, and alpha you can do in the near term. Beta, I would probably say no. That might be, unless you have a longer time horizon and you're looking for 2-3 years plus, then you can focus on, revival of the sector. And I would focus on producers because if the sector changes, production or producers that are generating cash flow will move first. And if you're going to hold that long, you want it in a decent jurisdiction, because you don't want a coup, expropriation, or something else happening in the term that you're holding the stock. So that would be my advice with respect to especially precious metals. But this is very commodity dependent, and so some other commodity like lithium is probably more that's more you could do a beta there probably, or maybe not so now with the valuations right now, but definitely last year it was more of a beta play. And what's driving a lot of the negativity, even with the critical minerals, is the weakness in China. So post-COVID-19 crisis, when they lifted the restrictions, everybody, including me, expected a bigger rebound in demand, which we haven't seen. Some of that might be due to trade restrictions and technology constraints as the US and other people are putting on China production, which might be impacting what they can actually produce. But right now, if we do see some kind of change where they're, injecting some stimulus into the economy, that can change a lot for some of these critical minerals like copper and nickel and things like that.
Well, I'd like to dive into some of these metals one by one with you and get your thoughts. And since you did just mention copper, why don't we start there? What are you seeing in the copper space right now? Obviously, there's a lot of sentiment that there's a supply squeeze up ahead. It's needed for a lot of green technologies. You talked about the energy transition earlier and how a lot more planning is needed. I think copper mines is one of those things. A lot of the people who are trying to push through a lot of these technologies and have them be fully adopted don't really understand the math when it comes to just how much copper is needed. So how do you see the copper space playing out in the years ahead?
Well, according to Freeport, which is a big copper producer, they expect I think a 50 million ton deficit by 2035, and that's right around the goals for many countries to become carbon neutral. And if we don't have enough copper, that's problematic. And right now, the price is not at a level to incentivize people to put in new development projects. Like my preferred exposure to the entire carbon neutral investment theme is something that's lower technical risk. So the problem with a lot of these battery metals and other technologies is the chemistry can change and the demand can change, like I said previously. But I don't think that that's the case for copper. It's harder to basically change copper out. And so what we're dealing with here is the demand growth, the higher intensity of copper usage in these new technologies, but then also on the supply side, which I'm more focused in on, the two of the largest copper producers, Peru and Chile, have become problematic jurisdictions, both left-wing governments, but Peru seems to go through a new government every 16 to 18 months. And Chile is changing their taxes and royalties, which they're implementing. They also want to nationalize lithium, and people are worried about maybe that being a contagion into other commodities like copper. And then what we're seeing is delayed expansions, whether it's Las Bambas in Peru or El Abra in Chile. So where people are putting in layers of production, saying here's production that we know, and that's going to tail down, and then we have brownfield expansions and highly probable development plays. Some of the even expansions that people are forecasting may not happen in the time frame that people are looking at, and that might bring some of these deficits forward. So that's the other thing I'm looking at. And then permitting in some of these places, especially in the US, we've had problems with Rosemont, back and forth with the Resolution mine in Arizona. The road to the Arctic deposit, the VMS deposit that South 32 and Trilogy have, that was suspended. But I think the industry realizes that copper is in a situation, and they're bullish about the commodity because we've seen M&A, whether it's BHP and Oz Minerals, $6 to $7 billion. Lundin buying a majority stake of the Caserones open pit mine in Chile. We've seen Sandfire buy deposits in Spain. So I think the industry sees this, and where we'll see first the consolidation is with production, but that doesn't change the supply-demand model, because we're just changing the name of the people producing copper, but we're not changing the volume. And so what we want to see is more M&A in the development space, where some of these projects start getting picked off, and that would be good. And we've seen a little bit of that with Rio Tinto making inroads into Casino with Western Copper and Gold up in the Yukon. So people are looking for lower jurisdiction, but then the issue about infrastructure becomes problematic.
And how about uranium? We're obviously seeing a new nuclear renaissance. Countries around the world are starting to embrace nuclear. There's a lot of reactors under construction, planned, proposed in a variety of different countries now. It's starting to feel like those who oppose nuclear are the crazy ones, when, if you go back in time not too long ago, it seemed that those proposing nuclear were treated as crazy. So there's been quite a 360 when it comes to the political view. And also the supply demand fundamentals seem rather strong. The incentive price needed for a lot of these miners to bring uranium out of the ground doesn't seem to be there yet. We saw a bit of an uptick in the spot price of uranium. I've spoken to some people, Mike Alkin of Sachem Cove, and some uranium company CEOs who are also saying that the contracting, the floor price on long-term contracts are getting higher in the uranium space as well. So where do you see uranium positioned? Obviously, a lot of the equities haven't performed. We're seeing a similar kind of low sentiment among investors when it comes to a lot of these junior miners in the uranium space. How do you see that all playing out?
Well, as you say, the issue is that with uranium, and most of what you've said has been the case for the last decade in terms of nuclear reactor facilities being generated, more uranium being needed, which hadn't changed the price of uranium until basically, I don't know, 3 or 4 years ago. And now when it was back to $20 to $25 before, now it's up to $50 to $55 in spot. What I've been always watching is, the signing of long-term contracts and the price of the long-term contracts. So in 2022 was the first year in a while where we've seen the volume of U3O8 under long-term contract being higher than that was on spot, because most of the nuclear power plants thought that there's a there's a huge inventory out there, and I don't want to get locked into paying 55, 60 when I could get it for 30. Now you can't get it for 30 anymore. And now with the Russian invasion of Ukraine, they produce 14% of U3O8 globally. And that's still going to enter the market, but it's just not probably going to enter the Western market. So the Western market has to think, well, where am I going to get my uranium? 80% of it is produced by state-owned enterprises. Half of that is Kazakhstan. Is that going to be problematic? I don't know. And then also with the conversion enrichment process, Russia has about 27% of the conversion capacity and 39% of enrichment capacity. And so I think that's where Cameco thought that there was an opportunity, not with expanding their production, because they've got a lot of production that's been curtailed, waiting for the incentive price to rise. So they can just sit on their production, much like what we did at Phelps Dodge in the 2000s when I worked there, when copper price was 50 to 55 cents. We just shut down production, and we held it until the copper price rose, and then we brought that production back on. And it was easier to do because all that production was permitted, and it was already much of the capital was already spent. So I think that's basically what Cameco is looking at doing. But interestingly, their stake in Westinghouse allows them inroads into the downstream in the nuclear reactor services business, basically to make up for Russian involvement in Europe. And so now they're going more downstream and trying to ensure that the uranium they produce has a home, basically. And as opposed to buying more development projects, they've done that. So we haven't seen a move in equities, because right now it'll be more about production and more about leverage to that, and the price being impacted directly to the ones that are actually making cash flow. And then we'll have to wait for that to go down to the developers, and then a better sentiment for the explorers and so forth.
Well, let's end on the precious metals, gold and silver. There's a lot of events happening around the world. Obviously, you discussed the invasion of Ukraine. There's been money printing going on like mad. There's been a lot of different things that have gold bugs pointing to the fact that the gold price should be a lot higher from a fundamental perspective. I wanted to get your thoughts on what you're seeing for gold and also silver. Do you see silver as more of an industrial commodity now, particularly with the push for the new green economy, or do you think it will continue to be recognized as a monetary metal? And will it track gold closely, or do you think it's an entirely different asset class?
Yeah, okay. With respect to gold, the gold price is not at a bad place right now. But the problem is that, a lot of people have been hit by cost escalation, so their margins had been impacted negatively. And as that cost escalation starts going down, gold price, their margins could go up even if the gold price stays at the same, as long as the cost escalation pressures reduce, and they could generate cash flow again. But what we see is mostly that, the gold price increase hasn't kept up with their cost increases, and hence the shrinking of the margin, and hence why most people don't think gold equities are very attractive at this moment in an environment of rising interest rates. But so what we're looking for is more M&A, but right now we're not seeing a lot of that. We've seen some, like a B2 Gold buying Sabina. But, in terms of the premium for long-term shareholders of Sabina, maybe it wasn't that much, but they probably thought that, what's going to happen in the next 2 to 3 years? Or is Sabina going to raise the whatever 500, 700 million themselves to build the project and just crush the equity price? Better to take the liquidity moment and just bail right here. So I think right now we need more M&A, but right now I don't see where that's going to come about in the current environment, because these guys are dealing with squeezed margins. When the margins start expanding, I think definitely we will see more M&A, because their pipelines are not there. With respect to silver, I would say that it is at a point where it might bifurcate. And like you said, if the demand is more speculation on precious metals, that part would follow gold because those are the investors that like that. But if it's industrial, then it's a completely different market, completely different investor. And then it would move more cyclically like your industrial commodities like copper and that, if it's all driven by, demand for solar panels. And the other problem with silver is that two of the major producers of silver, Mexico and Peru, are having their own problems. Mexico with their new mining reforms, Peru with their geopolitical issues and infrastructure issues. So that might impact silver supply. And I guess what we also got to realize, the big difference between gold and silver is most of the gold is produced by main product mines, whereas most of the silver, some of the major silver mines, are produced by byproduct. So they produce lead, they produce zinc, they produce other metals that drive their production. And the silver price doesn't incentivize them to produce more of their commodity because the silver just comes along with the lead. So that's a bit of a different dynamic for silver that'll always exist because of the amount of byproduct supply of silver. So that makes it very different also than gold.
Well, thank you so much for joining us today, Joe. A ton of knowledge shared. Really appreciate it. For those who want to learn more, could you tell us about Exploration Insights?
Yeah, Exploration Insights, .com is the website. It's been around since 2008 with Brent Cook. I took it over in 2016. We publish weekly based on what I'm buying and selling, but also a lot of themes that we just discussed right here, and how they would in fact impact our investments, and how we would change them with respect to that. And also we're on Twitter and LinkedIn, so I do publish some of my site visit notes and presentations that I do and conferences there, so you can follow us there. And there's lots of free material also on the website to get a taste if you're interested in subscribing.
Great. Well, I'll put a link to all of that in the description below for people who want to check that out. Thank you once again for joining us, Joe, and definitely looking forward to hopefully chatting again and continuing the conversation.
Great. Thanks very much.